Welcome to the deep dive. If you're a decision maker, an investor, or maybe a manager trying to steer a company through, all the complexity out there, accounting isn't just about math.
No, not at all. It's really the internal nervous system of your organization.
Exactly. And today, we are taking the most critical elements of financial and managerial accounting and turning them into strategic intelligence.
We're trying to cut through the mechanics to really get at the utility of these numbers. Our mission here is to move past the what and focus entirely on the why, and maybe most importantly, the so what.
Okay, let's start with the absolute foundation then, because if someone confuses the raw input with the analyzed output, they're really missing the entire point. What's that dividing line between simple bookkeeping and, well, true strategic accounting?
That's the perfect place to start. Bookkeeping is the systematic, the quantitative recording of activity. It's systematic data entry.
So just logging the transactions?
Exactly. It's necessary, but it's purely transactional. Accounting. That's the analysis and interpretation of that data.
Yeah.
It takes those raw inputs and transforms them into intelligence.
Intelligence that you use to evaluate where the company stands, inform big decisions.
And strategically plan for the future.
Right. So if bookkeeping is just maintaining the ledger, accounting is the executive summary that goes to the board. And that entire system, no matter how huge the company, it all rests on a single inviolable rule.
That's right. It is the bedrock. It's the closest thing finance has to a law of physics, the accounting equation.
And that is?
Assets equal liabilities plus equity.
And the power in that simple equation is that it's a constant diagnostic, right? It forces you to ask, okay, we got this asset, but how?
Precisely. Every asset you own has to have a corresponding claim on it. You either borrowed the money for it, that's a liability, or you paid for it with money from the owners or profits you've kept over time. That's equity.
And if the equation doesn't balance...
The system is broken.
Well,
it must always hold true.
With that bedrock established, let's look at how the outside world, the lenders, the investors, the regulators, how they see your company. And this means talking about the three core financial statements. Let's start with number one, the balance sheet.
The balance sheet is the snapshot. Simple as that. It tells you exactly what an organization owns and what it owes at one specific moment in time. It is literally the accounting equation in a report format.
And this statement, even though it's designed for objectivity, can produce some really surprising results that managers have to understand. I'm thinking of the famous McDonald's brand value story.
Oh, it's a classic case study in what's called accounting conservatism.
Yeah.
McDonald's has one of the world's most valuable brands, right? We're talking tens of billions of dollars.
Sure.
Yet on its official balance sheet, that brand value is recorded as zero.
Zero. How does a manager even begin to reconcile that massive gap between economic reality and the financial report?
It illustrates a key rule that internally generated intangible assets, like a brand you build organically through years of advertising, are just not recorded.
So it forces you, as a manager, to realize that the balance sheet, while technically correct, can seriously understate the true economic value of your business. You have to know what it leaves out.
You have to, especially for, knowledge economy companies.
That's a critical insight. Okay, so if the balance sheet is the snapshot of where we are, then we need the income statement to show us how we got there. Statement 2, the movie of the company's activity.
Exactly. The income statement covers a period of time. It shows the flow of revenues and expenses that lead to your net income. It's your measure of profitability.
And the history of McDonald's gives us another sharp lesson here. Ray Kroc's company once reported a profit, a small one, like $77,000.
Right.
But immediately afterward, they had to go borrow $2.7 million. I mean, that's the clearest possible distinction between being profitable and actually having cash.
Which brings us directly to statement 3, the statement of cash flows. This is the lifeblood report. It separates, truth from theory by showing a manager exactly where the hard currency came from and where it went.
And this statement breaks down every cash transaction into 3 vital buckets: operating, investing, and financing activities.
And for a manager, one of those classification details is really important: interest paid on debt. Under U.S. GAAP, interest expense is classified as an operating activity.
Okay, now that seems a little counterintuitive. The debt itself is a financing activity, so why is the interest considered operational?
Well, the thinking is that the expense of servicing that debt is a cost of maintaining the ongoing day-to-day operations of the business. You have to keep paying interest to keep the lights on, so it gets lumped in with other operational necessities.
Okay, that rationale makes it easier to remember. And if you look at the real-world data, like the McDonald's figures, you see this massive difference between the income statement and the cash flow statement. They had, what, over $5.4 billion in net income?
But almost $7 billion in cash from operations. That's a huge gap.
A $1.5 billion gap. Where does that come from?
It's primarily from accrual accounting concepts like depreciation. Depreciation reduces your net income on paper, but it's a non-cash expense. You're not actually writing a check for it.
So it doesn't reduce the actual currency in your pocket.
Exactly.
Yeah.
And that difference is why decision makers have to treat the cash flow statement as the ultimate measure of financial health. Cash is king.
Okay, it makes a ton of sense. So let's switch gears a bit. We've been talking about financial accounting, which is designed for those external users.
Right, for the public.
But managers need specific internal tools for planning and, for optimizing efficiency. This is managerial accounting.
Yeah, managerial accounting is all about optimization. It's forward-looking, and it allows for customized reports. You don't have the same strict rules as financial statements.
So let's start with an efficiency test,
Yeah.
the accounts receivable ratio. Specifically, using AR as a percentage of sales to see how fast you're collecting cash.
This tells you how fast you turn a credit sale into actual money. So let's imagine a scenario. Total sales were flat year over year, but your AR as a percentage of sales decreased, say, by almost 3%. What does that tell you?
Well, if sales didn't move, that decrease means the AR balance itself must have shrunk. And that can only happen if we collected cash on older accounts faster than we were adding new credit sales.
Exactly. It signals a major efficiency improvement in your collections, a huge operational win.
Because you're increasing cash velocity without having to find new customers.
Precisely.
Okay, next up, planning. Every manager needs to know how changes in volume and costs are going to impact the bottom line, and that's cost volume profit, or CVP, analysis.
CVP is the fundamental predictive tool. It forces you to separate costs into two behaviors, fixed and variable. The key insight here is that when your sales volume changes, say it drops by 20%, what happens?
Your total variable costs will drop in lockstep.
Right, but your total fixed costs, they remain static.
And managers can use the contribution margin, that's sales price minus variable cost per unit, as the key predictive lever. So if a company knows its fixed costs are $150,000 and the contribution margin per unit is $20, what happens to profit if volume drops from 10,000 units down to 8,000?
We can forecast that pretty quickly. At 8,000 units, the total contribution is $160,000. Subtract the fixed costs of $150,000.
And you've got a forecasted net income of $10,000.
Right. And the strategic takeaway isn't just the $10,000 number itself. It's that the manager now knows the exact sales floor they need to hit just to cover their fixed costs. Drives all sorts of decisions.
Pricing, inventory, everything. Okay, moving to cost allocation. Managers need precision here. Let's quickly distinguish between direct and indirect costs.
Sure. Direct costs are the easy ones. They're easily traceable to a specific cost object like the wood for a chair or the salary of that specific department's manager. The real strategic challenge is in the indirect costs.
Because indirect costs, like the factory utilities or the overall supervisor's salary, they benefit multiple products and have to be allocated, not traced. And that allocation can hide some huge inefficiencies.
This raises a critical question. How do we get past a simple volume-based allocation that might penalize a complex low-volume product or make a simple high-volume product look artificially expensive?
And that's where activity-based costing, or ABC, comes in.
ABC is a leap forward in accuracy. It uses multiple cost drivers based on actual activities like machine setup time or the number of inspections to assign those indirect costs. It reveals the true cost of complexity.
But accuracy comes at a price, right? What's the strategic trade-off a manager faces when they're thinking about implementing ABC?
It's a big one. It's way more complex, more time-consuming, and more expensive to run than traditional systems. You really only implement ABC when you think the potential inaccuracy of the old way is actively misleading your product or pricing strategy.
Okay, to make that tangible, let's look at total manufacturing overhead. If we add up all the indirect production costs, utilities, repairs, depreciation, indirect labor, and they total $227,000. And we made 20,000 units.
The basic calculation is pretty straightforward. You just divide the $227,000 in total overhead by the 20,000 units you produced. That gives you an overhead cost per unit of $11.35.
And knowing that number is essential for valuing your inventory and setting your margins.
Absolutely.
Let's cover one last critical managerial tool for budgeting, the cash disbursement schedule. This forecast needs managers to track payment policies across multiple months.
Right. So say a new policy is put in place. You pay 30% in the month of purchase, 50% the month after, and the final 20% in the second month after. We'd need to pull the purchases for March, April, and May to figure out the cash going out in May.
And when you factor in the portions from each of those 3 months,
Yeah.
the total cash outflow for May comes to $24,100. And this exercise is so important for making sure you actually have the cash on hand to meet your obligations.
It's all about cash visibility. That is the cornerstone of responsible managerial budgeting.
So now that we've covered the internal and external views of the company, let's shift to the regulatory and ethical environment that makes all this information reliable for such a huge audience.
Right, the foundation of public trust is compliance. All U.S. public companies must file detailed periodic reports, things like the 10K and 10Q, that contain audited financial statements with the SEC.
And that auditing process has protections against conflicts of interest. What's the key rule that enforces independence for the auditor?
Auditors of public companies cannot participate in the design of their clients' internal controls.
Why not?
Well, if they help design the system, they can't objectively audit the results. It's a crucial separation of duties to maintain that independence.
Speaking of controls, what's the single most effective internal control a manager can implement to prevent theft of physical inventory?
Restricting physical access. It's fundamental. Locked doors, keycard systems, limited access points. No amount of paperwork can replace just controlling who can physically touch the assets.
And when the auditors come in, what's a core part of their initial work before they even start checking the numbers?
They spend a significant amount of time documenting the company's procedures for financial reporting. They're testing whether the controls management has put in place are actually adequate to prevent a material misstatement.
And we mentioned rules. Who actually creates GAAP, the generally accepted accounting principles that dictate how all this information gets compiled?
GAAP is developed primarily by the FASB, the Financial Accounting Standards Board, and it's important for managers to know that the FASB is an independent, private sector organization, not a government body.
So where does the government oversight come in?
That falls to the PCAOB, the Public Company Accounting Oversight Board, which basically monitors the auditors themselves.
So what does this whole ecosystem, the reports, the rules, the controls, what does it all create? Who is the ultimate beneficiary of all this structured information?
Well, financial accounting is primarily aimed at external users, most critically, investors and creditors. They're the primary decision makers who determine if they're going to fund or lend to the company.
But the real strategic insight here is just the sheer breadth of that user base. It's not just a conversation between a company and its bank.
What's fascinating is how pervasive this information becomes. Suppliers use your statements to check your credit risk. Competitors use them for strategic intelligence. Employees and unions rely on them to check the stability of their jobs and pensions.
So the financial statements are really the company's public report card.
Exactly, read by virtually every stakeholder.
And as a manager, you really have a dual role in all this. You're the main internal user of the managerial tools we discussed, the CVP analysis, the cost schedules, but you also have to use the financial accounting information to benchmark your competitors and check the stability of your key suppliers. You have to be fluent in both languages.
That holistic understanding is what separates a good tactician from a true strategist. Everything we discussed is designed to translate complex economic activity into a unified, actionable language.
And that brings us full circle. We covered the unbreakable bedrock of accounting with that assets, liabilities, plus equity equation.
Right.
The public story told by the 3 financial statements and the internal tools like CVP and ABC.
And the ability to leverage all that knowledge is what allows you to allocate resources and set strategy effectively.
So to leave you with a final provocative thought, we saw that because of accounting conservatism, internally generated assets like the McDonald's brand assets that drive massive revenue are intentionally reported as $0 on the balance sheet. This raises an important question for you, the decision maker. If the official reports are designed to ignore your company's most powerful, unrecorded internal asset, how do you adjust your capital allocation and your acquisition strategy to ensure you are funding the true economic value of the business rather than just the stated book value?